Have you ever felt like you're falling behind price action in your analysis? Today, we're going to break open the heart of the market: pivots. I've already explained what pivots are. Essentially, they're the turning points of the market, and the entire market structure is built around them. If you can master pivots, you can analyze, forecast, and trade any market. In this session, I'll explain the different types of pivots so you'll understand which ones are tradable and which are simply reactions or pullbacks to broken levels. If you want to truly dominate the pivot concept and trade the market step by step, watch this video until the end. I also recommend checking out all the videos linked in the description. There are three types of pivots: reversal pivots, pullback pivots, and settlement pivots. Reversal pivots are the most important because identifying them allows you to trade with high win rates and capture big moves. All previous lessons have been about identifying reversal pivots. To identify these pivots, you only need to focus on three things: the base of the leg itself, and the reversal candle. The leg's base is important to understand where the move started. It could look like price consolidating or minor pullbacks. Check the chart. I've marked the bases of 1-hour legs for you. Every leg must be at least 240% of the average true range of the current time frame to be considered valid. Its maximum length should not exceed 240% of the ATR of the higher time frame. We discussed this in full in the previous video. Once a valid leg is in place, we need a reversal candle with specific conditions so that we can enter right at the market turn. Make sure you watch the pivot video linked above. When a reversal pivot is confirmed, we can enter a trade at its FTC zone with minimal stop loss and maximum reward. But have you ever wondered why some pivots just don't work? In this video, we'll explain why. There are three types of pivots in the market, and if you treat all of them the same and enter at every FTC, you'll only be profitable in about 33% of cases. That's why recognizing pullback and settlement pivots is critical. Quick note before we go deeper: I'm planning to launch a private Telegram group where we can talk about these strategies, review charts together, and help each other grow as traders. I'll personally answer your questions and share bonus insights. If that sounds good, drop a quick comment below saying, "I'm in." Once we hit 100 comments, I'll launch the group and invite you all in. Pullback pivots form after a classic level is broken. Once price breaks a level and pulls back to it, that pullback often creates a pivot. These aren't valid for trading. The FTC zone in these pivots is weak and won't reverse price. You might get a small reaction, but price will usually break through. Important notes: 1. If a pullback pivot forms on the daily, weekly, or monthly time frame, we do trade them. Even small reactions on those time frames are worth a lot of pips. You can drop to a double trigger time frame and enter with solid risk to reward. 2. Typically, the distance from the pivot to the broken level equals about 1 ATR of the broken level's time frame. We'll explain why in the breakout videos coming soon. Settlement pivots. Price creates settlement pivots when it moves between two aligned levels. Imagine price is between two 4-hour levels. It touches the lower one, sentiment shifts, and buyers step in. As price nears the upper level, those buyers start closing trades expecting a reversal. That creates a settlement pivot. These also have FTC zones, but those zones can't reverse the move. Price will keep going until it hits the main level. Keynotes: 1. Settlement pivots often form near minor levels, visible as trading nodes on higher time frames. 2. They often form after sharp movements. When there's a spike and a pivot appears afterward, it's usually a hunted pivot, not tradable. 3. They're mostly seen in the trigger time frame. When you see a leg forming on the 4-hour time frame, that leg has created pivots along its path on the 15-minute time frame, but these pivots are actually settlement pivots. They're not tradable. You need to focus on the time frame of the levels the price is moving toward. For example, if the level belongs to the daily time frame, you should only trade a pivot at that level if the pivot was formed by a daily leg. If the leg that formed the pivot is only 1 hour, then that pivot is a settlement pivot, and its FTR, failure to return, is likely to get hunted. Types of settlement pivots. Divergence doubles. A first pivot forms before price hits the main level. The second pivot, a reversal, hunts the first and forms after price enters the level, starting a trend reversal. The second pivot should not be more than 127% Fibonacci away from the tip of the first. CP drivers. Inspired by the 3 drivers pattern, but with differences we'll explain in upcoming videos. In this pattern, pivots form close to each other near classic levels as part of a price settlement process aimed at clearing resting orders. Caps. These are rally-based drop or drop-based rally patterns. These bases are formed for settlement, and their FTC zones are not good trade entries. However, there are specific base trading strategies. We've already taught one, and more are coming. Trading pivots on the chart. Now that you know the type, how do you identify what type of pivot is? Always start by identifying the nearest levels. Watch the level timeframe detection video. You'll need to find 2 levels before and after the pivot. When levels are marked, you'll have a much better idea of where price is headed and what kind of pivot has formed. Example, you find a 1-hour pivot. Levels above are 4H and daily. Below are 1H and 4H. Price came from the lower 4H level and broke through the 1H level. Where is it headed? Likely to the upper 4H level, because price moves between aligned levels. So this pivot is probably a settlement pivot and will get hunted. Its FTC is not a good trade. Let's apply this on the chart. Open the chart and look at the most recent high or low. Does it meet trade conditions? We're on the daily time frame. The leg is less than 240% of the higher ATR, but more than 240% of the current ATR. Now it qualifies as a daily leg. Next, check the candle that made the last high. Is it a master candle? It must have at least 80% body or wick. This one clearly isn't. So, use a virtual line. So, to assess whether a pivot is forming, we use an imaginary line. This line is drawn from the tip of the peak at a distance equal to 80% of the ATR of the time frame, because price must return by at least the size of a standard candle and close below it for a pivot to be likely. We then check to see if the return candle closes below this imaginary line. It's valid. Now check if the 23% node is engulfed. This matters because the leg's length is between 240% and 360% ATR of the current time frame. Use Fibonacci extension 0 on the pivot tip, 1 on the end of the leg. Mark the nodes. Go to the 1H trigger time frame. Find the 23% node. It's engulfed. Back in the main time frame, define the FTC zone. Reverse the fib, 1 at the pivot tip, 0 at the leg end. FTC lies between 0.78 and 0.89. Mark the FTC node. When price returns to that zone, enter the trade. Extra tips for better results. 1. You can set a limit order at the FTC or wait for entry confirmation like a trendline break. 2. If you're aggressive, put the stop above the FTC node and target forward nodes. If you want less risk, put the stop above the pivot. 3. For higher win rates, focus on where the pivot formed. This one is on a daily level, not on a trigger level, so it's not a settlement pivot. It's not a pullback pivot either, because it didn't form after a level break. So this is a solid trade setup. If this lesson helped and you're ready to master advanced trading, subscribe and stay tuned for the next videos.